Welcome to the candle section of the course. In this section, you'll learn basic and advanced concepts about candles. The first thing I want you to do is create a clean mind canvas. Erase everything that you believe you already know about candles. Even if you think you know all there is to know about candles, I like to request that you forget all of it. To get the utmost value out of this price action mastery course, it's better to approach it with an open mind. So that means there's not a single second of this course you should skip, as all the concepts and methods tie into each other. Let's unlearn and relearn. This way you'll be able to view the market with a new perspective. Let's begin. What is this? This is a brand new baby candle that was born less than a second ago and has yet to move a single pip in either direction. This candle is completely neutral. But in about 4 hours, when this candle closes, it will tell us what prices did in the last 4 hours. If this candle moves up a little and then drops down fast and closes like this, it's a bearish candle. It means sellers had overall control of price. This is the candle's story. It shows us that sellers won the struggle with buyers and they pushed price down. If instead, price pushed up and closed up here, we can conclude that buyers won their struggle against sellers. So buyers are in control. That's the story of this candle. Now, just with that simple example, you can understand why candles are very important. Let's take a further look at the anatomy of a candle. Generally speaking, a green candle indicates a bull candle, and a red candle indicates a bear candle. This is usually determined by the OHLC, or open, high, low, close. The open and close is determined by the body, and the high and low is determined by the wicks. Wicks indicate the high or low of a candle and can be likened to footprints of where the candle has traveled during the life of the candle. Yes, the life of the candle, as each candle represents a time frame. The time frames that we use most at Epic FX is monthly, weekly, daily, 4 hour, 1 hour, 30-minute, 15-minute, and 5-minute. Essentially, the life of a candle is determined by the time frame you're viewing. If you're viewing the 4-hour time frame, it means that a new candle is born every 4 hours. And if you're viewing the 1-hour time frame, it means a new candle is born every hour, and so on. Being able to switch between higher time frames and lower time frames will give a wealth of information regarding the movement of price. And being able to break down a candle will provide the ultimate edge in trading. For example, here's a 4-hour candle. Let's see how it was formed on the 1-hour time frame. These candles on the right are 1 hour each, and there's 4 of them making up the 4-hour candle to the left. Let's break it down even further with another example, taking one of these 1-hour candles. Here's our 1-hour candle on the left, and the 15-minute candles to the right make up the 1-hour candle on the left. There's 4 of them. This is a very important skill because when we look to create a top-down analysis or even look to enter a trade, we'll use higher time frame versus lower time frame for advantage in the market. Additionally, once you're able to break candles down in this manner, then you'll truly begin to understand that price and trading charts are really just one candle. Let's take a look here. This is overall price structure, but all candles make up one big candle. Let's say there was a time frame called decade. Each candle makes up 10 years of price. 3 candles will make up 3 decades. Here's an instrument with data from May 1993 all the way until 2022. The candle is born here at 175. It travels down, creating a swing low at 123, and comes all the way back up to 245, making a swing high before reversing to come back down to 147,500. After which travels back up, closing out the first decade in 2003, bullish, roughly around 200. And here's what it looks like when we add the next decade from 2003 to 2013. The second decade closes bearish at 165,500. And the final decade is currently bearish from 2013 to 2022, floating around the 150 level. Literally, the candles are the market and market structure. Each candle provides a ton of information that once you're able to identify and absorb the story that's being told, you'll witness immense improvement in your bias, setups, entries, and even trade supervision. Let's take a more complete look at Wicks. Wicks will determine if we will enter a trade or remain in a trade. They also inform us if price is exhausted, stalling, or able to continue. Commonly, wicks are overlooked by traders, but are virtually one of the sole methods to identify a false breakout or fake out of price. The point is, wicks are more than just a means to spot price rejections or the highs and lows of a candle. Look at these candles. Is there anything that you notice? It's pretty difficult to notice something that you're not looking for, correct? Or to pinpoint a thing that was not on your radar. I want to bring to your attention the wicks. There's about 145 candles here. The majority of these candles have an upper and lower or top and bottom wick. Only 20 of them do not. That means 86% of all these candles have a top and bottom wick, indicating that it's the norm for a candle to have an upper and lower wick. Let's learn what it means when a candle doesn't produce a top and or bottom wick. We must split these into two categories: opening no wick candles and closing no wick candles. We'll begin with closing no wick candles. We have a bullish candle that closed with no top wick. It opened up, created a bottom wick, then continued driving up and closed with no top wick. This generally means that there's no range for price to continue driving up, and the bulls are overpowered by the bears, and thus the bears put a firm stop to buying momentum. We can see the same with a bearish candle. It opened up, created a top wick, then continued driving down and closed with no bottom wick. There's no range for it to continue. The bears are overpowered by the bulls. There are some situations when there's a ton of volume and momentum in the market that price is moving far too fast, and this rule doesn't apply. However, when that occurs, you'll be able to immediately identify such a scenario. Generally speaking, when a trending candle doesn't create a wick upon close, then there's no range left for it to continue. This will also explain a concept known as Wick Fills. Here's an example. We have a range. Price goes up, then comes down, and then goes back up. This is your basic range. There's support and resistance. We're now looking for a breakout. In order for us to take buys here, we need price to break out above the range. We finally get a candle that makes a perfect closure above the range. It has a bottom wick and a nice top wick, meaning that there's range to continue driving up. But what if we get a candle like this? There's a strong bottom wick, but no top wick upon closing. It means that there's no range for price to continue driving up. Here's why it matters. Majority of candles normally have a top and bottom wick. We have an open, we have a close, we have a low, and we have a high. Let's say this is a 1 hour candle, and then we switch to the 15-minute time frame, which gives us 4 candles making up this 1 hour candle. These 15-minute candles to the right represent the 1 hour candle to the left. The last 15-minute candle was bearish and created a support, which resulted in the wick on the 1 hour candle. This is why we can state that a wick is a range, because in that wick there is support and resistance on a different time frame, which creates the range. So, if the upper wick of this 1 hour candle represents a range, then we can expect that in a trending market, the lower time frame or these 15-minute candles will fill this wick or fill the range. This is what that will look like. 1 hour shows us we have another bullish candle that continued up, and on the 15-minute time frame, price created support to continue up. The wick on the 1 hour became support and a range on the 15-minute in order for price to continue driving up. Once we break the high on the 1 hour candle, it translates to breaking the resistance on the 15-minute time frame. In conclusion, a closing candle with a wick indicates that there's a range. whereas a closing candle with no wick means there's no range for price to continue. In the example of the uptrend, there's no buys because there's no range for price to fill. Price is halted at resistance. We only seek buys once price breaks the resistance. Let's look at a bearish candle example. It's exactly the same concept, but in this case in the reverse. We have 1 hour bearish candle to the left and our 15-minute candles to the right. There's 4 of them. The last 15-minute candle is bullish, which forms the wick on the 1 hour candle. This is now a range formed. Price on the 15-minute created a support and resistance. Once price comes down to fill the wick on the 1 hour time frame, that translates to creating the resistance to continue the downtrend on the 15-minute time frame. It's the same scenario on the uptrend example, but on a downtrend. Now let's take a look at opening no wick candles. Here we have a range. Price is in an uptrend, and we're looking for price to continue up to fill the range. In this uptrend scenario, it means that we're looking for the next candle to have a bottom wick. If this next candle opens up bullish without creating a bottom wick, we should expect the candle to come back down flipping bearish in order to create the bottom wick. As you now understand, the majority of candles have an upper and lower wick. Only after a lower wick has been formed should we consider entering a trade contingent upon the new candle. There are times in this scenario where we can enter the candle and not wait for the bottom wick to form, but in those cases, usually the bottom wick was created on the same candle but a different time frame. This concept is very important because being a successful and profitable trader requires engaging in high probable setups and quality entries that are in your favor. Here's an example of a downtrend. Here's our range, resistance formed, and support formed. Now we're looking for price to continue down to fill the range. In this downtrend scenario, we're looking for the next candle to have an upper wick. If this next candle opens up bearish without creating an upper wick, we should expect the candle to come back up flipping bullish in order to create the top wick before possibly continuing down to fill the range. That wraps up the candle section. Hopefully you have a greater appreciation for candles and can now comprehend just how important they are in being able to decode the epic of the bulls versus the bears. I'll see you in the next section, Trend.